Everybody, welcome to our fifth webinar of our 7-webinar series at the Stu Clark Center. Today is all about raising capital, a fun conversation to have when it comes to money and raising funds for your business. So hopefully today you'll be able to learn something and find some value as it relates to your entrepreneurial journey and some advice and tips on raising capital. Before we begin, just a couple of housekeeping items and some Zoom etiquette reminders. Video is optional. However, we would greatly appreciate it if you stayed on mute throughout the webinar. We will be using the chat feature to ask any questions throughout the webinar as usual. So if you do have any questions, feel free to type them out in the chat or just pop the letter Q in the chat if you don't want to write out your whole question. And at the end of the webinar, we will invite you to either ask your question or read off your question from the chat. And lastly, but not least, this webinar will be recorded and uploaded to our online resources section of the website. So if you have to leave early, that's totally okay. You can catch up and finish watching online. And if you have anyone that you think might find value in watching the webinar, feel free to send them the link once it's uploaded. A little bit about me. My name is Joshua Zapperzan. I am the venture coach at the Stu Clark Center, where I get the awesome opportunity to meet with students across the entire university and all different faculties at all different stages of their business planning cycle to help and coach them along their startup journey and answer any questions that they might have. I graduated from the Asper School of Business in December of 2016, and I myself am an entrepreneur. My company is called Odax Ventures. I've built and sold an apparel company. I also work for the League of Innovators, a not-for-profit Canadian enterprise that provides free educational resources to youth. And I'm also the vice chair for the Young Associates here in Winnipeg. On the call today, we also have our awesome Stu Clark Center team that comprises of Deborah Jonason-Young, our director, Lindsay Friesen, our program coordinator, and our newest member of the team. A big welcome to Leah Mickelson, our office administrator, and myself as the venture coach. This is our team, and if you have any questions whatsoever about the Stu Clark Center or what we do or how we can help you, please don't hesitate at any point to reach out to any four of us and ask your questions. We're here to help and support your entrepreneurial journey however best we can. Feel free to visit us at the website, umanitoba.ca/entrepreneur, and follow us on Instagram at Stu Clark Center. Just in case you missed it, our fourth webinar, which was a couple weeks ago, we talked about the business plan and all the essential components of building the business plan. Feel free to, if you did miss it, it was recorded as this one is. And to find it, you can visit our online resources section on our website by clicking the left-hand tab there, online resources, and scrolling to the bottom where you'll find the recording. And that's where you'll also be able to find this recording as well as previous webinars and be able to RSVP to our 2 remaining webinars for this year. All right, so today's all about raising capital. As we mentioned, a very interesting and fun topic of conversation as it relates to cash. So what we're going to cover today are a few different things. First and foremost, why and when to raise capital and what that looks like. A couple of key questions to ask yourself before going about raising capital and things you need to consider. We're going to talk about this concept of debt versus equity financing, pros and cons, and really structuring that around this common theme of looking at these 2 different options when raising capital. We're going to look at different sources for raising capital. So when it's actually time to go out and about, where do you look and what are some great options for you? And then I'm going to give you my top tips for raising capital. So a reminder, any questions, pop them into the chat at any point and we'll get to them at the end. So before we begin, I begin every webinar with this. I'd love to get to know all of you who's on the call. So I'm going to throw out a quick poll. It is anonymous, so would appreciate your engagement and your response, but I just want to know if you're an entrepreneur. So I'll give you a couple of seconds to fill it out and then we'll move on. Awesome. See all the results trickling in here. I'll give you a few more seconds. Looks like we have a good variety. Couple more seconds. Any final last votes? And then we'll share the results. All right, let's see. Okay, 50% of you know, but you want to be. Awesome. Glad to have you here. Hopefully you'll be even more inspired after this webinar to be an entrepreneur. 25% of you are an entrepreneur. Awesome. 13% of you, I have an idea but don't know where to start. Perfect. Well, best way to start is come see me, book a meeting at the Venture Coach, and I'll help you out and we'll get you on your way. And 13% of you said no as well. That's totally okay. Cool too. And hoping maybe one day you will be an entrepreneur, but good and still happy to have you here at the webinar. So thanks everyone for contributing and engaging with the poll. Awesome to see. So I always start every webinar and every speaking engagement that I do by making one comment, and that is that I don't have all the answers, and nor really do I think anyone does. And I don't know everything, but I have learned a lot, a fair bit through experience about business and entrepreneurship. And at the end of the day, I just want to share with you those lessons that I've learned. By no means am I claiming to be an expert today in raising capital and financing, but the goal really is to share some of my real world experiences with you and hopefully draw a connection to your entrepreneurship journey, and so that you can find value with what you're doing with your startup or your business, or what you might encounter with your business down the road in the future. Okay, so why and when? Although it's commendable to get by without investment into your business, you've managed to bootstrap your business. It's not always necessarily something to be proud of, nor is it always the right strategy for every startup. Every business is different, and important to understand why your business is different and really why you need capital and when you need capital. So I'm going to give you 5 quick reasons for why you should consider raising capital, especially with a startup. The first one is to scale quickly. If you were to bootstrap and use bootstrapped money or small loans here and there, you'll eventually be able to launch. But in the meantime, a good analogy could be that a competitor could come along with a lot of cash and scale and beat you to market. So the traditionally slower forms of financing could mean a missed opportunity for your startup. In contrast, having a much larger cash infusion up front can help scale up to a more visible operation size and add that necessary talent to get work done. It could mean the difference between a year and just a few months, and as a result really can go to market faster and ahead of others, especially if you're in a niche space. So having that extra cash and that cash influx really allows you to scale and scale quickly. Secondly, gain credibility. As I mentioned earlier, some people see asking others for money as a sign of weakness. I believe it's quite the opposite. When someone is willing to give you a substantial amount of money or funding, it shows that they see potential in your startup to succeed. They believe in you as an entrepreneur as well. And they see that you're going to deliver something compelling to the market and provide value to its target audience. So this outward display of approval really builds that instant credibility with stakeholders. And if it does happen to be a substantial amount of money, you could also get an incredible amount of media coverage. That is a bit of a perk that you listen to some venture capitalists and entrepreneurs talk about, is they want the media exposure. So that's why they go down the route of raising funds from VCs, because it is quite well covered in the media. The third reason is so that you can tap into resources beyond just money. The beauty thing about raising money, especially from an investor, is that you can get more than just financial backing. And that outlay of cash comes with extensive resources, business expertise, and instant growth within your own network. As an entrepreneur, you may not be able to reach such that of an extensive base of resources due to limited experience. So these resources can include legal and tax services, access to research, and any investor relationships can also lead to other introductions within their network. So it's really about providing more than just money and having that strategic partner or that strategic backer to help you along your journey. Fourth is assistance with that strategic direction. Every startup can benefit from a connection to a seasoned and experienced individual who understands risk, who understands strategy, who understands having to make tough decisions. With an investment and a return on the line, people are more vested in your interest in your business, and they're more than happy to help and serve as an advisor, provide feedback, provide support to help your business. So again, that concept of really going beyond money. Many of these investors or institutions, even banks, they come into a startup at times or have resources to come into a startup and become more hands-on to help guide their investment towards success. They care about their money. They don't want to see it go to waste, and they don't want to lose it. So this assistance can be so beneficial when a startup founder may not have that experience, such as even if it's human resource management or financial management and marketing. So that ability to assist with day-to-day problems plus getting cash is super important. Lastly, generous terms. Now, this one's very dependent on the type of capital you raise and the funding you seek, but you could provide room to breathe when it comes to paying it back. And we're going to get into this more later in the webinar when we talk about sources of funding. But if you're talking with a VC or a person who's investing in your business, it's very different than a loan, and you can have a lot more generous terms in terms of not having to pay it back and paying interest. And so there's a lot of flexibility and support and benefits to having, personal assets to grow your business as collateral for the money you borrow, and vice versa. So at the end of the day, there's a lot of many benefits to having extra capital within your startup. And just remember, though, it's important to do everything in your power to deliver a return, whether it be to an investor or to a bank. You're always held accountable to someone or something at some point. So undertaking a really good due diligence strategy to understand, who do you want to let inside your company too, is something that's super important, and we'll touch on later. But the last thing that I want to mention on this slide is that question of when. When do I go and raise financing? When do I seek capital? When do I have these conversations? And the answer is that it's when you're ready. There really is no set timeline or set stage in which you have to go raise funds, or you should seek funds. Every business is so different. And if there's one message to really take from today's webinar, it's that every business is at different stages, and every business, depending on the product, depending on the service, depending on the industry, depending on your plan, your scalability, your growth, every business is different. And there really is not one blueprint to raising capital. What worked for someone else might not work for you. It's not guaranteed. So you need to understand your business, your needs, and look at all options. There really is no simple answer with this topic of conversation in terms of what's the best way to get funding or when to get funding. And you have to be patient, do your research, and be creative as an entrepreneur to find out what that best solution will be for you and your business. So the last thing you want to do when you go into this conversation and topic of raising financing or capital is that there's not one set strategy to follow. So really be open-minded and really consider what is it that you need and your business that's going to suit you best. So that leads into a couple of key questions to ask yourself before you go and raise capital. It's super important to ask yourself and consider all of these key questions before you seek the capital. You need to understand your position again in order to make that right decision. And if you consider all of these questions, you won't waste your time. As an entrepreneur and a founder, your time is one of the most precious assets that you have. You don't want to waste your time trying to raise capital if you haven't already given thought to these questions, essentially knowing that you're ready. So the first one is really to understand, why are you looking for money? Why do you need the money? So many entrepreneurs that I meet with, and they want to talk about raising financing and cash. And I asked them this question about, why are you looking for money? And surprisingly enough, there's not a strong answer to that. It's just because they think they need it. They think they have to. But reality is you don't. You really need to understand why it is you're looking for money and understanding why you need it. Secondly, how much do you need? And not only how much do you need, but how are you planning to spend that money? You can't go ask for money unless you know specifically how much you need to ask for, and also how you're going to spend it. If you approach an investor or even a bank, they're going to want to know what you're spending that money on. And if you can't properly outline and explain that to them, then you're not going to raise. You're not going to have any success finding cash. The next one is, do you want to consider outside investment or loans? We'll kind of talk about this later on, but do you want to bring someone outside into your business and have them as a partner and part of your structure? Or are you willing to take on debt and a loan? And that brings us to our next question of debt or equity, this common theme again, which we're going to talk about here shortly and spend more time on. But are you comfortable taking on debt? Do you want to dilute your equity? What does that look like? What does your cap table and your structure of your organization look like from that perspective? Is it the right time? Are you ready? Are you still trying to validate your business, or are you actually ready to scale and grow? Big difference between validation and scaling, as we'll talk about here in a second too. So really understanding, is this the right time? The next one, what are the risks and rewards? What are the risks and rewards to raising capital, to bringing on a partner, to taking on debt? Really, what does that look like? And also, what does that look like from a tax perspective? What does that look like from an organizational perspective, a personal perspective? All of those things to consider as well as part of risk and rewards. And lastly, this concept again, are you validating or scaling? I think so many entrepreneurs, they think, oh, they get confused between validating and scaling in the sense of I need money to validate my idea versus I need money to scale and grow my business. And there's a huge, huge distinction to be made there, and one that is, I think, super, super important. And that brings us to this point of really understanding the difference of raising money to grow your business versus money needed to validate your idea. Don't skip the validation side of things. Our conversation is today is very surrounded around the idea that you've most likely already validated your business idea and you're ready to scale and grow. And that's why you're looking for capital. If that's not where you're at, then definitely it's time to take a bit of a step back and think about what it is that you need in order to validate your business idea so that you can prove that the business most likely will be a success in the market. You found a target audience. You've given proof that they want whatever it is that you're selling or you're going to be providing to them. So really understanding this difference between validating and scaling is super, super important. And it also helps to answer that question of when. When is the right timing to raise capital? I'm going to take a step backwards and talk about validating. And I have this rule that I read it a long time ago, and I can't remember where, but it's always stuck with me. And it's this rule of 10 and 3. And this is when it comes to, again, remember, validating, not scaling. But I strongly believe that you can test and validate any business with $10,000 or less and no more than 3 months. Keep this in mind because, again, don't waste your time or unnecessary money and be creative. You're an entrepreneur. Use your skills to bootstrap and to do things in such a capital efficient way, especially when validating, so that you don't waste time. When you're in that validation stage, the last thing you want to do is go seek a $30,000, $50,000, $100,000 investment when you haven't actually validated your business idea and proven that there's a market and that it's going to work. When you are validating, just think you can validate anything with less than $10,000 and less than 3 months. Don't spend years trying to validate a business. If it's taking you that long, chances are it probably won't work. So keep that in mind, the rule of 10 and 3. It's something that's always stuck with me, and it provides a really good snapshot in terms of when, again, answering that question of when you're ready to raise money and at what stage and how to go about the validation stage. Okay, so we're going to get into this conversation of debt versus equity. And these are really the two biggest forms of financing that you can look into for your startup. So to raise capital for business needs, companies primarily have these two types of financing as an option: equity financing and debt financing. Most companies will use a combination of both debt and equity financing, but there's some really distinct advantages to both and disadvantages. The principle among them is really that equity financing carries no repayment obligation and provides that extra working capital needed to use to grow a business. Whereas debt financing, on the other hand, does not require giving a portion of ownership, but you're now owed on a certain term schedule to repay that amount of money. So companies usually do have a choice as to whether to seek debt or equity financing. And that choice often depends upon which source of funding is most easily accessible for the company, its cash flow, and how important maintaining control of the company really is to those principal owners. So let's look a little bit more into each one. First of all, equity financing. So what is equity financing? Equity financing is when you sell a portion of your company shares in exchange for money. So for example, like on Dragon's Den, when startups and founders, they go and they pitch to these investors and they ask for a certain amount of money, and they're willing to give up a percentage of their business in order to get that money. That main advantage is that there's no repayment obligation. As in the example on the screen, you don't have to pay back that $100,000. There's no obligation to do so, but you've just given up, say, for example, 15% of your business or more or less, depending on the valuation. And so that big disadvantage, though, is that you give up equity and ownership of your company. And to some degrees, and how some deals are structured, is you can actually lose some control, some decision-making power, and you have this new person or institution now that owns part of your company, and you now have to listen to them, structure them into your corp structure, have them as now an owner, and listen to their thoughts as well as advice. So both pros and cons to equity financing, as there is with debt financing as well. Now, debt financing, on the other hand, is when you borrow money and you pay it back with interest, usually on a set term. So, for example, that $100,000, but you're paying 8% interest over a 5-year term. Now, your main advantage for this is that you're keeping all of your equity. You have full control of your company. The lender has no control. They can't really make decisions in your day-to-day operations. And from a tax perspective, too, that interest you pay is a tax deductible. So a couple advantages there. The biggest disadvantage is obviously that you have to repay this amount, and you have to repay it on the institution's or the lender's schedule. So you're really betting on your future to pay back this money. And it's a common question and a common topic of conversation to really, is debt cheaper than equity in terms of entrepreneurship? Do you believe in your business? Do you believe in keeping every single piece of equity right until the end, or until you absolutely don't have to? And that's really where you hear that theme of bootstrapping come into play, where you try and do things so small until you absolutely need the financing. I've heard and I've seen people that I know hear these horror stories of, they've got these awesome business ideas and really cool ideas, and they go to raise all this money, but they give away so much of their company in terms of equity at the beginning. And what a lot of entrepreneurs forget is that if your business is really growing and scaling, you usually have to raise financing, not just once, but it could be multiple times. And at each stage of raising capital, you're giving away more and more equity if you're using equity financing. And you hear these horror stories of these entrepreneurs that after a number of years, they almost own next to none of the company that they started and they founded, because they started to give away too much equity too early. So that's a huge, huge key thing to remember as a founder, to hold on to as much equity as you possibly can for as long as possible. And that's just one thing that I want to stress as an entrepreneur as well to consider. Now, that being said, it's super important that when you decide whether to finance your new business venture through loans or through equity financing and giving up shares, it's such a serious matter and so important. It's such a crucial decision, and you have to fully understand your options before making these decisions. And you need to talk to people, get advice, get other opinions. And don't just get advice and opinions from one person. Get them from multiple people in multiple industries, in multiple ways in which they know you, and gather that feedback. And really, it's a serious decision. You can't necessarily go back on it once that decision's made. With that being said, I want to ask all of you, if you had choice, what's better, debt or equity? I'm going to throw out a poll, and I'm only giving you the two options. If you had to choose to raise cash through debt or through equity, what would you choose? I'll give you a couple seconds to answer, and we'll see what everyone says. Awesome. I'll give you a couple more seconds, couple last minute votes coming in. If you had to choose debt or equity. Okay. Let's see what you all said. So 67% of you said debt financing and 33% said equity. Cool. That's good. That's good. I think, especially from an entrepreneur perspective, a lot of the times we say as entrepreneurs that debt is cheaper than equity, like we kind of just, or I kind of talked about, in terms of holding on to every last piece of ownership that you have in your company. So thanks everyone for participating. Great to have your feedback and to hear your thoughts on that. So what is better? Is there an answer? Well, the simple answer is that there is no answer. It really, truly depends. The equity versus debt decision relies on so many different factors, whether it be the current economic climate, the business's existing cap structure, and the business's life cycle stage, just to name a few. So it so depends. Debt is not always cheaper than equity. It sometimes is, but it isn't always, especially like when I take you back to that first slide, that conversation of, getting or more than just monetary value and cash, some of those resources and expertise that comes along with some of those investments that you give away equity for. So it's not always cheaper than giving away equity, but definitely a serious matter and something to really give a lot of thorough thought to when you're looking to raise cash. So let's dive into a few sources for raising capital. So where can you actually look, and where do most entrepreneurs actually look when it comes time to raising cash? The first one is friends and family, but be careful and be cautious. The last thing that you want to do is take on a business investment from a family member or from a friend and have any chance of ruining that personal relationship that you have. And you, again, you hear horror stories sometimes of close family members investing a lot of money into another family member's business, and then that business not doing so well, and losing all that family's money. And sometimes it's just not best for the relationship. So definitely be careful and cautious with that one. I've always heard and heard people say that if you're going to invest in a friend or family, you have to go into it with the expectation of knowing that you're never going to get that money back. And it looks like it's more of a donation than an investment. So if you are investing, maybe that's the best approach and mindset to take. But it definitely is an option, especially as you talk about those lower micro loans or those smaller amounts in order to help validate. Friends and family is, at the end of the day, a great or a good source to look at. Secondly is crowdfunding, such as Kickstarter campaigns. Great way not only to advertise your business and to show your creativity, and I'm sure you've heard of some of these really cool Kickstarter campaigns and videos that businesses have put together to showcase their product just with an MVP in order to pre-sell products and to raise cash. So a really cool way of more of a modern day way to raise capital, and Kickstarter campaigns are kind of the best way to do that. But there are a few different crowdfunding options for raising capital. Thirdly, is through this concept of venture capitalists and angel investors. There are so many VCs and angels in the world, and so many different funds. There's local VCs, there's global VCs. So it's about, when it comes to looking at VCs and angels, it's about finding the right fit and finding and seeking out venture capitalists and angel investors who have experience or interest in your industry and or your niche, so that you're really starting to find that strategic partner in terms of more than just cash and what else they bring to the table. But definitely a very popular way, especially when raising a higher amount of money, is to look at venture capitalists and angel investors. And and you can just, through Googling and looking that up and talking to people locally, like the Stu Clark Center or other organizations, you can find a lot of lists of VCs and angel investors, as well as other funds. The next one are business incubators and accelerators. There's so many, both virtual and in person, now more so all virtual because of COVID, incubators and accelerator programs that not only offer, again, money, but they also offer resources, they offer connections, they offer support to help you and your business grow. So it's, and the nice thing about business incubators and accelerators too, is they also usually have those really good, strong relationships and connections to venture capitalists and to angel investors, so that when it comes time for that second raise of funding, you already have a network open to those individuals that could be of great interest. So business incubators and accelerators, a great way to find capital and to gain extra support. Next are winning contests such as the Stu Clark New Venture Championship. Such a great way to not only practice your pitching skills, to get feedback from industry judges and industry individuals, and potentially maybe even VCs, but you can also win a fair chunk of money from it, and raise money to use for your startup and for your business. There's so many business plan competitions, pitch competitions, logo competitions, you name it. Do a search online for all different contests, and a great way to apply and win cash that way too. And absolutely 100% the Stu Clark New Venture Championship as well, which will be in the new year. The next one are government grants. I think this one is so overlooked by entrepreneurs because there are so many grants out there for all different reasons. And the problem with grants is that they're very, very specific. So they could be grants specifically for a certain industry, specifically for hiring a certain type of intern for a certain position. But at the end of the day, that money's out there. And so if you're looking to grow and scale and you need to take on cash, again, you're asking those questions at the beginning. Why do I need the cash? Maybe the answer for why is because you want to build your team and you want to hire an intern or an employee. Well, now you know too, let's start looking at grants. Let's look for a grant specific to that. It's, at the end of the day, it's free money. And there are so many out there, but they are hard to find. And so a website that I highly, highly recommend every entrepreneur goes onto and looks. It's called granted.ca. It's an organization. I think they're based out of BC, but they will help curate a list. It's their job to find all of the different grants for you. There's a free version and a paid subscription version where they actually customize grants specific to your business. But there is a free version where you can get a list of all the grants out there and you can sift through them yourself. Highly, highly recommend it and look at grants. It's an awesome way for entrepreneurs to raise money. Next are government funded programs, such as, like, for example, Futurepreneur. Fantastic programs that provide, these are more loans and resources, not necessarily just free money, but not only with the cash, it comes a lot of mentorship and access to other resources. So there's some really great other government programs, and they're not necessarily just government programs. There's also some privately funded programs out there as well that you could definitely look into. Next are loans, whether it be through a bank, an institution, or through a person. Banks don't typically like dealing with entrepreneurs, as they don't like to take on risk, and chances are high that it'll be at a higher interest rate that you would be paying it back. But it definitely is an option. Some banks, especially depending on, again, your validation stage and who you have backing you, and your other assets that the company might own, it could be a great opportunity and a great option. And or finding personal loans through an individual, again, having to pay that back, though, remembering that difference between debt and equity. But definitely a great option, especially if you don't want to give up any equity, and if you do know someone or have a personal connection. It is, at the end of the day, a good way to access cash. My last comment here is to get creative. A lot of successful entrepreneurs, when it comes to raising capital, they're not going to look at just doing a crowdfunding or a Kickstarter campaign, or just finding grants. They're combining all of these different options in order to get the amount of cash that they need. And so being really creative in terms of, okay, what grants can fit in for what I'm doing? What venture capitalist do I think is going to provide the best outside resources for me? What kind of combination of tools can you use to raise the capital that's required for your business? The last comment that I'll make, there's nothing stopping you from doing it, but I highly advise not to do it. Don't use all of your personal credit cards or your personal line of credits to pay for a big $50,000 business investment. Obviously, there's nothing stopping you to do it. I believe you should never have to put those items that are your personal assets on the line, so that just in case you ever needed them for anything personally. But especially if you look at credit cards that have a 20% interest rate, you don't want to be paying back that much money or in interest, especially as a startup, and if you haven't really proven or validated your business to that extent. So look at all these other options first, talk to other people, and get feedback. And that's the best way to go about the funding situation. That being said, as an entrepreneur, it is so important, as much as possible, to bootstrap, do things efficiently. And one of the reasons why, the most important reason, is that investors, when it comes time that you actually do need to raise a lot of money, one of the things that investors and banks look at are, how capital efficient have you been to this point? And if you can show that you've bootstrapped and you've done things and found ways to save money and to not spend much, it makes you that much more credible and that much more appealing for a future investment. So as much as possible, especially in that validation stage of raising cash, bootstrap. Okay, my top tips. We're just about done here. My top tips on raising capital, I've got a few for you. First one is to be loud. Let people know. Tell people about your idea. Tell people you're raising money. You never know who it is that you're talking to, and many connections they might have, and or if they maybe have a little bit of cash that they might invest into your business too. So talk to people. Be loud about it. Don't be quiet and shy about it. Be confident, concise, and clear. A lot of the times people invest in people, not always just investing in the idea. The investor wants to invest in you, the entrepreneur. So show that you're confident, show it in your idea, show that you can clearly explain your business idea, and be to the point. The other comment that I'll make with this is that the investor world is tight knit, especially locally. So don't burn bridges, because if you burn one bridge and kind of, for the lack of better terminology, piss someone off in the investment world, there's a high chance that another venture capitalist or another fund is going to hear about your experience, and it might not favor you the next time around when you reach out to that next person. So be careful about that one. The next one is to be distinct. Focus on what makes you different. Focus your value proposition about why someone should give you money. And more importantly, how are they going to make money in return, or how are they going to be benefit? And really what makes you different in terms of standing out and being a great option for someone to invest in you and for raising capital. So focus on that perspective. Validate your idea. Super important. Show proof. Make sure before you go for your big raise to raise capital, you've already validated your idea. You've validated it in a bootstrapping way. You've been capital efficient, and you've proven that your business is going to work. You will be way more likely to raise cash and capital at this stage if you're able to do this. If you're unsure about validation and validating, check out our second webinar or our series that we talked about validating your idea. And it's this common theme. We've actually kind of talked about it in every single webinar, I think, but super, super important to make sure that you validated your idea and you show that you have. Next is to know your business better than anyone else. Be an expert, show your passion and show your knowledge for your industry and for what you're working on. Remember, people invest in people. They don't always just invest in the idea. So prove to people that you can execute on this and that you do know your business better than anyone else and that you are that right person to lead your business. Build relationships. And this is where you can start early. It is never too early to start building relationships. Now, don't get that confused with being too early to ask for money. It's too early at times to ask for money, but it's never too early to start building relationships. Build relationships, build your network so that when you are ready to raise and have those conversations about raising capital, you already have that network of people that they've been following your entrepreneurial journey, or they know what you're working on, and you already have a bit of a personal connection. So it's never too early to start your building relationships. Next is to do your homework. Find the right fit. Don't just take cash out of desperation, especially if you're giving up equity. You want to find that right fit. Most of the times you want to find both a cultural fit and a strategic fit. Bring on the right person and don't just be desperate for cash. The last one, the most successful tool that you can build and create in order to raise capital is your pitch and your business plan. You need to know how to pitch. You need to have your pitch well done, practiced, and by heart. You never know when you might meet a potential investor. And you need a business plan for applying to any grants, most of the government programs and banks, even venture capitalists. They're going to ask to see a business plan, ask to see your financial projections. So make sure you have a really good pitch and a business plan. And that kind of just leads me into saying, again, stressing the importance of the pitch. And if you don't know where to start, watch our pitch webinar on the website in our online resources section, because it is super, super important. Probably the most important piece of raising capital is your pitch and the way that you portray your business and your idea. And probably the biggest factor that goes to your success in terms of being able to raise capital is the way in which you pitch your business. So please, if you have questions about your pitch, don't hesitate to reach out. Lastly, my comment, again, as I say all the time, is that you cannot build a successful business with a flawed foundation. You cannot raise capital with a not well thought out and not validated business. Investors and banks and institutions and programs, they need to know that your business has all those key components to launch, to grow, and to scale, and that you are the right person to build that business. People invest in people, not always the idea. Make sure your business is built with that perfect foundation so that it can support a cash injection, it can support growth, and it's ready to scale and take on to the next level. So what are today's key takeaways from this raising capital webinar? First of all, understand what the benefits are to raising capital for your business. Really ask those key questions. Don't ask for money too early. Know when the right time is. And really remember that every business is different. You have to consider all of those key questions before seeking capital and understanding why do you need it? When do you need it? Why is this the right time? What all those benefits are. The rule of 10 and 3, when you're validating, be capital efficient. Don't spend any more max than $10,000 and no more than 3 months to validate your idea. I firmly believe in this for any business, no matter what it is that you're doing. Again, that's validating, not raising and scaling. Understand the pros and cons of debt versus equity financing and really which is best for you. Understand your risk tolerance level. understand, again, this partially goes back to the validation stage again about what suits you more and what's comfortable in the best situation for you and your startup. Again, every startup is different. So really understand the pros and cons and the implications of debt versus equity, and seek feedback, seek help and advice in that area. Next one, bootstrap your startup as much as possible. Show investors how capital efficient you can be. I can't stress this enough. When I've spoken to investors and gotten feedback and helped other entrepreneurs with raising cash, that's one common theme. Investors love to see how capital efficient you have been up to this point, because it gives them such a clear indication of how you're going to be with their money and moving forward. So show that you're capital efficient prior to really going to raise cash. Research all of your sources for raising capital and find that best fit. Again, it's about you. It's about your business. What worked for anyone else might not work for you. Do your research. Research all of those different sources and get creative. Combine them. Look at grants. Look at VCs. Look at banks. Look at loans. Look at Kickstarter and crowdfunding campaigns. So really do your homework and research all of those sources to find the best fit. And the last key takeaway is to make sure you build and practice your pitch. Again, so important for when it comes time to raising capital. It's make or break at the end of the day. If you can't properly pitch and you can't display and communicate your idea to that investor or to that bank or to whoever it is or in that competition, you will not get that cash. So make sure you build and practice your pitch. As always, we understand that as an entrepreneur, you can't do it alone. And there's so many great resources in the community to help you through your entrepreneurial journey, including financing. As we talked about on the screen, you'll see a few different logos. These are some of the community resources that we at the Stu Clark Center have. If you have any questions about them whatsoever, do not hesitate to reach out to us. You aren't alone at no matter what stage you're at in your business planning and entrepreneurial journey. We're here to support you, and so are all these community resources. So don't hesitate to reach out and learn about how the community can help you in your business. Lastly, if you do have any questions and you would love to meet with me one-on-one, I would absolutely love that opportunity to do so and to help you with your business. Feel free to book a meeting with me through Startup Tree. And to do so, you can find the link on our website, umanitoba.ca/entrepreneur. On the left-hand side, click the Venture Coach Program tab, and you'll see instructions and a list of how to go ahead and book, see my calendar and book in a meeting. So I hope a lot of you take advantage of that. Finally, before we get to questions, just a note, our next webinar is on November 25th at 11:30 a.m., where we will be talking about marketing, how to market your startup, and some cool marketing strategies, techniques that you can implement in your startup, essentially at very low cost, again, focusing on bootstrapping, but in general, building the cool marketing strategies. So please RSVP if you'd like to attend. You can do so the same way through Startup Tree, and hopefully see all of you, if most of you, if not all of you, at that next webinar. So with that being said, I hope everyone found value in today's webinar. I will invite Lindsay off mute here and see if there's any questions. Don't hesitate to ask.
Perfect. Thank you, Josh. And thank you for that great presentation. I see there was a couple questions in the chat. We had someone asking to repeat that website. So again, it is www.granted.ca for the grants that Josh was mentioning.
I'll pop it in the chat here.
Oh, sorry. Yep. We have another question. If I'm offering a VC 10% equity and a guaranteed 15% ROI, would they be looking for a long business plan or a one-page plan basically explaining how to pay them back?
On that note, the first thing that I will say is you be careful when you use the word guarantee. If you guarantee a VC and approach them saying, I'm going to guarantee you a certain ROI percentage, be careful because that could come to haunt you down the road if you can't fulfill that. However, that being said, yes, not a one pager. They're going to definitely want to see, if they're going to invest in your business, they're going to want to see more than a one pager. So the most important part will be to see your financials, your financial projections, as well as your validation, your market research. So I would say, yeah, more than a one pager for sure.
Perfect. For validation stage, in terms of return, what is the optimum return as percentage does VCs or other institutions look at? Or do?
Yeah, that's a good question. Very good question. And to be completely honest, that varies. It varies depending on the industry you're in. Some industries, like in the tech industry, they're going to want to see a very large multiple return on investment. However, if it's something that's a lot smaller of an industry, it varies. So I'm not going to give you a number because it is very, very specific to your business. It also depends on not only the industry, but what your plans with the businesses are. Maybe you're only going to grow it as a side hustle or a family business, and you're not looking for a massive exit in 5 years of 10 times multiple or something. So it is very dependent on your business and the industry you're in. So I wouldn't go into it with a specific return that individuals are looking for. It really depends on individual circumstances, but that's also a good conversation to have with VCs and with institutions about what their expectations are. It's totally okay to ask them, hey, if you were to, and this is again, back to that relationship building stage. It does not hurt to ask someone, hey, if you were to invest in a business, what's your expectations? What kind of returns do you look for that entices you in order to invest? So definitely an interesting conversation, but yeah, I can't give you a one number because it does vary.
Another question, just to continue the conversation, if we are talking about your business, what number did you have?
Good question. I'm going to personally choose to keep that one confidential. It was a private sale. We weren't a public company, so I'll elect to keep that one confidential, but we did well. We were a company that was had distribution throughout North America, and we did have a good multiple, but I'll choose to keep that one confidential for personal sakes.
Perfect. Any other questions, guys? Please put them in the chat now. We'll stay on here for a couple more minutes in case anyone has some more questions for Josh. Again, I encourage you, if any of you are too shy to speak up now, please feel free to book a one-on-one with him. It's free of charge. It's a great resource. You can probably tell Josh is full of wisdom and great feedback. So take advantage of that and book your one-on-one with him. No other questions here.
No other questions? Well, if there is, I will stick around here for a couple seconds, but just want to thank all of you for joining us. And if you do have anything, please reach out to us. Don't hesitate. And we're here to help however we can. So thank you for joining us, and we will hopefully see you at the next webinar. I'll stick around though if there's any last minute questions.
Thanks, Josh.